We've seen the crude oil prices gain up by 10%, and it is 20% up now in the last 1 month.
Now, analysts estimate a security premium of up to $10 per barrel is now priced in.
You may not follow every headline from the Middle East, but if you've noticed your gas bill rising, your grocery tab growing, or your Amazon delivery fee inching up, then you're already feeling it. Oil prices are climbing, and it's not just about markets, it's about a war. As Israel strikes Iran and Tehran threatens to retaliate, global energy flows are at risk. The result? American consumers, from commuters to families, are starting to pay the price for a conflict thousands of miles away. Since fighting erupted between Israel and Iran on June 13th, oil prices have surged, up over 10% in a week and 20% over the past month. Brent Crude briefly touched $78 a barrel before easing to around $75. What caused the spike? Not just the fighting, but the potential disruption. Israel has struck multiple energy sites in Iran, including a refinery fire in Tehran, damage to 2 gas processing plants in the south, and a partial shutdown at South Pars, one of the world's largest gas fields. The Ashan oil depot was also targeted. So far, no major export facility has been disabled. But markets are reacting to risk. And that risk centers on one place, the Strait of Hormuz. Roughly 20% of global oil flows through this narrow waterway. A recent tanker collision in the area, amid suspected interference, underscored how quickly things could unravel. Markets have already priced in a $10 per barrel security premium based on that risk alone. According to analysts cited by Wyon and ExxonMobil executives on Fox Business, markets have priced in a $10 per barrel security premium, purely based on fears of escalation.
When you have oil prices rise, you have diesel prices rise. I mean, that's how trucks get your and my Amazon packages, our groceries, our cell phones when we go buy them at the store.
To many Americans, oil prices are just numbers until they show up at the gas station or on a grocery receipt. A jump of $10 to $15 in oil can ripple through the entire economy. Gas and diesel go up. That means higher costs for deliveries, farming, construction, and food distribution. It hits hardest in summer. Road trips get more expensive. Weekly gas bills climb, but it doesn't stop there. As diesel rises, so do warehouse costs, shipping fees, and even grocery logistics. One week, it's your delivery surcharge. The next week, it's milk, then lettuce, then eggs. So while missiles fall in Tehran, the economic shock hits checkout lines in Texas, Ohio, and everywhere in between.
Is that President Trump would be on the phone to the likes of Saudi Arabia and the UAE to pump more oil.
Interruptions. The position of OPEC and the position of OPEC with spare capacity is that they would go in and add supply.
Can anything stop oil from climbing higher? President Trump faces pressure to stabilize prices. One possible option, asking Saudi Arabia or the UAE to increase supply. But that's risky. If Gulf states ramp up production, it could inflame Iran, which has warned, if you hit our oil, we'll hit yours. OPEC Plus has already restored some output, adding 400,000 barrels a day. But Gulf nations are treading carefully. They don't want to be pulled deeper into this conflict and risk becoming the next target. Then there's the Federal Reserve. Before the crisis, the Fed planned to pause interest rates, but rising oil prices have complicated that. Chair Powell now faces a mix of tariff uncertainty, inflation pressure, and shaky consumer confidence, all of which could delay efforts to support the economy. Markets are on edge, supply chains are alert, and policymakers are bracing for impact. You may not live in Tehran or Tel Aviv, but you'll still pay for this war. At the pump, in your grocery run, and through every quiet price hike in your daily life. This conflict isn't just military, it's economic. And American households once again are footing the bill.
U.S. steel and aluminum prices soared on Monday after President Donald Trump said he would double tariffs on the two metals to 50%.
This week, a new wave of tariffs just took effect, and it's already shaking up U.S. manufacturing. On June 4th, the Trump administration officially doubled tariffs on imported steel and aluminum, from 25% to 50%. While metal producers are cheering, the auto industry is bracing for impact. Here's what you need to know about how this policy is affecting car prices, production, and investment strategy across the country.
The tariffs are pushing people to buy cars now rather than, they're worried that.
Let's start with what looks like good news. Ford reported a 17% jump in U.S. vehicle sales in May, driven largely by strong demand for trucks and SUVs. But analysts say this spike isn't a sign of healthy growth. It's consumers buying early out of fear that prices are about to jump. That's because raw material costs, especially for steel, are about to hit automakers hard. At the same time, Stellantis and Nissan are facing serious inventory issues, with vehicles sitting on lots for 90 to 107 days, forcing deep discounts. And that's creating a dilemma for companies like GM and Ford. Do they raise prices to cover rising costs or cut prices to stay competitive? Either way, profit margins are getting squeezed.
So steel represents about 2,800 pounds of each car. It's over $1,000, almost $2,000 of cost for each car.
Here's why the pressure is so intense. According to Reuters and MSNBC, aluminum prices surged 54%, and U.S. hot-rolled coil steel rose 7.5% in the days after Trump's announcement. That adds $1,500 to $2,000 in production cost to every vehicle, based on average steel weight per car. Investors noticed. After the tariff hike, Ford and GM shares both dropped around 4%, reflecting market concern over profit outlooks. Meanwhile, steel and aluminum producers soared. Cleveland-Cliffs jumped 23%, Century Aluminum gained 21%, and Steel Dynamics rose over 10%. A sharp contrast showing who stands to win and who's left absorbing the blow. But tariffs don't just increase costs. They break production flow. Auto manufacturing depends on synchronized parts and just-in-time logistics. When input costs like steel and aluminum spike overnight, manufacturers scramble to renegotiate contracts, shift suppliers, or delay builds, each step adding more complexity and risk. According to Morgan Stanley, the U.S. still imports about 17% of its steel needs. So a sudden 50% tariff creates shock not just in pricing but in logistics and planning. Even automakers with domestic production capacity face bottlenecks and rework. These aren't abstract disruptions. They're changes that ripple through assembly lines, dealerships, and ultimately consumer wallets.
Lauren, General Motors is unplugging its big EV push, so to speak, and instead is now focusing on production of V8 engines, the ones that operate on gasoline.
As reported by Fox Business, the shift isn't ideological, it's economic. Automakers are now responding to tariff-driven cost realities, not just policy goals. The EV transition isn't being reversed, but it's being delayed, reshaped, and made more expensive. Electric vehicles depend heavily on aluminum and high-strength steel. When tariffs raise those input costs, production gets pricier, fast. That's part of why some automakers like GM are adjusting course. The company recently invested $888 million in V8 engine production in Buffalo, signaling a partial shift from an all-electric push. GM hasn't blamed tariffs directly, but rising input costs and unstable supply chains are clearly shaping new strategies, including a potential return to hybrids. Internationally, trade partners are watching closely. The global impact is just beginning. Canada and the EU are threatening retaliation, and trade talks with China are again under strain. Meanwhile, the OECD has cut U.S. GDP growth forecasts from 2.2% to 1.6%, citing rising production costs. Larry Summers warns, in 2018, steel tariffs added just 1,000 steel jobs, but downstream industries lost over 75,000. Tariffs may help U.S. steel mills, but they're straining automakers, dealerships, and consumers.
Tesla shares hitting session lows here. That is amid, as we were just talking about, growing tension between Elon Musk and President Donald Trump.
But forget all that. The stock is down like 13, 14.
Elon Musk versus Donald Trump, one of the most explosive public feuds in recent years, is now shaking Wall Street. Tesla stock has lost $150 billion in market value. Musk's personal fortune shrank by $34 billion in just one day. But it's not just about stock prices. This feud is sending shockwaves across America's economy. Today, we break down what triggered the clash, why Tesla investors are panicking, and whether tensions are cooling or just beginning.
Meltdown. The Elon Musk and Donald Trump alliance has gone up in flames. Total and utter flames.
It all began with a disagreement over Trump's one big beautiful bill, a sweeping tax and spending plan. Elon Musk called to kill the bill on X, attacking the spending and disgusting pork. Trump fired back, claiming Musk only turned against the bill after learning it would cut EV mandates and tax credits, key to Tesla's sales. At a White House press conference, Trump said, "Elon knew this from the beginning. When we cut the EV mandate, he became different." Musk immediately responded, "False. This bill was never shown to me even once." Then he escalated, claiming, "Without me, Trump would have lost the election," and ultimately accusing Trump of being in the Epstein files. News outlets, including CNN and NBC, confirmed no evidence of wrongdoing. But the post deepened the rift between Musk and Trump.
Tesla's stock price took a massive hit after that. $150 billion in market value gone as the two were trading attacks today. According to Bloomberg, Elon Musk lost $34 billion today.
As the feud escalated, Tesla stock plunged. Between June 5th and 6th, shares dropped 13 to 14%, erasing $150 billion in market value. Musk's wealth shrank by $34 billion, according to Bloomberg. What's driving the sell-off? First, brand damage. Musk's attacks on Trump alienated both left-leaning and right-leaning Tesla buyers. As Barron's reported, now everybody is irritated with Tesla. Sales have been very weak in 2025. Second, the bill would eliminate 7,500 federal EV tax credits by year-end, adding pressure to Tesla's margins. And third, looming risks. Trump threatened to cancel Musk's federal contracts, including those for SpaceX, which handles about half of the world's orbital launches. Musk warned that this could disrupt access to the International Space Station. These risks, both real and potential, are driving investor fears. Beyond Wall Street, this feud is reshaping political alliances. Trump insists Musk is acting out of self-interest. Musk says he's fighting on fiscal principle. But here's the key. Musk controls enormous political capital. He spent $288 million backing Trump's last election, according to CNBC. Now, he's openly threatening to fund challengers to pro-Trump lawmakers. As Politico reports, this is creating real tensions inside the Republican Party. Lawmakers now face a choice: stick with Trump or risk losing Musk's support. A dangerous prospect with midterms approaching. Late on June 6th, signs of a possible truce emerged. Musk posted he's open to cooling things down following calls from investors like Bill Ackman. Trump told Politico that relations with Musk are going very well. The White House is arranging a call between them. But as CNN noted, insiders believe Musk's Epstein files post may have crossed a line. Even if a truce happens, trust between Musk and Trump and the market's confidence may not recover soon. For now, Tesla stock remains battered. Trump's one big beautiful bill faces new hurdles, and the Musk-Trump alliance may be fractured beyond repair. We'll keep tracking this story. If you found this update useful, be sure to subscribe and stay tuned.